Missed out on Tesla? Didn't buy Nvidia when it was cheap? We've all been there. But here's the thing, you don't need to find the next hype stock to grow your wealth. Sometimes the biggest gains come from boring, cash-rich companies that for some reason are at their 52-week low. In this video, I'm walking you and John through 5 rock-solid dividend stocks that are now trading near their 52-week lows. I'll show you exactly why these stocks are down, why they're still fundamentally strong, and how much your $10,000 investment could grow if you buy while they're cheap. In the end, I'll show you one of the best 52-week low stocks, one that even Warren Buffett bought millions of shares of last quarter, and how a $10,000 investment in that stock could turn into a $1.4 million portfolio that pays over $15,000 in monthly dividend income. But first, let's all get on the same page. What is a 52-week low, and why does it matter for you? A 52-week low is simply the lowest price a stock has traded in the past year. In plain English, it's like finding your favorite sneakers at the lowest price they've been in 12 months. But a low price doesn't always mean a bad company. Sometimes great businesses get caught in temporary storms, earnings disappointments, scary headlines, or just overall market jitters. The business itself might still be rock solid. That's where the opportunity comes in. When you spot a company with healthy financials, steady dividends, and a proven track record, yet it's trading near its 52-week low, that can be your chance to buy quality at a discount. It's like shopping the clearance rack and finding brand new Air Jordans for half off. They're still the same sneakers everyone wanted a month ago, they're just cheaper now because most people are too spooked to grab them. Of course, not every stock at its low is a hidden gem. Some are sinking ships. The key is figuring out which ones are temporarily down versus permanently broken. That's what I've done here. I've handpicked 5 dividend-paying stocks that are financially solid, temporarily beaten down, and set to reward patient investors. So let's start the countdown. Coming in at number 5, I've got Elevance Health with the ticker symbol ELV. This company runs one of the largest health insurance businesses in the U.S. If you've ever heard of Anthem Blue Cross, yeah, that's them. But despite being a giant in the healthcare space, ELV stock has been having a pretty rough time lately. It recently hit a 52-week low, trading around $270 to $300. For most investors, that kind of drop feels like a red flag, and to be fair, the sell-off wasn't random. Elevance cut its profit outlook because medical costs have been running higher than expected, especially with Medicaid and Affordable Care Act plans. When hospital bills and doctor visits get more expensive, insurance companies like Elevance have to cover the difference, and it eats straight into their profits. Naturally, Wall Street didn't clap for that. Big firms like Morgan Stanley and Bernstein quickly downgraded the stock, saying margins could stay squeezed for a while. But here's where things get interesting. Despite all of this, it could be a short-term hiccup, not a long-term problem. Even the CEO stepped in recently to scoop up some shares around the low point. Insiders don't risk their own money unless they see something the market's missing, and that's usually worth paying attention to. On top of that, the numbers show the stock looks cheap by historical standards. Elevance is trading at a price-to-earnings ratio around 13 or 14. For a company this large, with steady cash flow and relatively low debt, that is a bargain price. Add in the fact that the dividend yield is over 2%, and suddenly you're looking at a stock that not only protects your money but also grows it steadily through reinvested payouts. Elevance pays a 2.31% dividend, grows that dividend at over 12.14% a year, and its stock price has averaged about 6.35% growth. To put it into perspective, let's say John takes $10,000 and puts it into Elevance today, reinvesting every dividend along the way. After 1 year, that grows to about $10,866. In 10 years, it'll be worth $24,476. Give it 20 years and it'll grow to $73,609, and by the 30-year mark, that same $10,000 snowballs into $314,609, paying around $31,462 in annual dividend income, or about $2,622 in monthly dividend income. Out of that, $130,046 would come from capital appreciation and $174,562 would come from reinvested dividends. So the total value added to the initial investment would be $304,609. Fourth on the list is Equity Lifestyle Properties with the ticker symbol ELS. This isn't your typical real estate trust with shopping centers or luxury apartments. ELS makes its money in a different lane: manufactured home communities, RV resorts, and campgrounds. That means affordable housing and low-cost vacation spots, two areas that tend to hold up even when the economy gets shaky. Even though ELS beat both earnings and revenue expectations in Q2 of 2025, the stock still dipped. Why? Well, part of it is seasonal. Demand naturally softens during certain months. The bigger picture is that people are jittery about slowing growth and a cooling economy. With people worrying about slower growth and a softer economy, the stock drifted down about 10% year over year. But that surface-level weakness hides a really strong foundation. Most tenants in manufactured housing communities stay put for years, sometimes decades, which makes the income stream super stable. Plus, there isn't much new supply being built, which keeps pricing power in ELS's hands. Their operating income and cash flow are still projected to grow at a steady mid-singles-digit pace, not flashy, but reliable. And when it comes to compounding wealth, reliability is priceless. Right now, the stock trades at a PE ratio of about 31 to 32 times. That might seem high, but compared to the residential REIT sector average of over 50 times, ELS actually looks undervalued on a relative basis. Yes, their debt load is a bit elevated, but their operating cash flow is strong enough to handle it. They're also expanding divisions in both manufactured homes and RV resorts, so there's real growth potential baked in there. Now let's look at the metrics that make this stock compelling. ELS has a dividend yield of 3.38%. Its dividend growth rate is 10.99%, and the average annual return from share price appreciation has been about 7.74%. If John were to put $10,000 into ELS today and reinvest every dividend, here's what happens. After 1 year, he'd have $11,112. Fast forward 10 years and it grows to $30,126. Stretch it to 20 years and that $10,000 becomes $103,502. And by year 30, the portfolio balloons to $424,920, paying around $31,226 annually in dividends, or $2,602 per month. That includes $217,027 from capital appreciation and $197,893 from reinvested dividends. The total value added over the 30 years would be $414,920. If you think these numbers look good, wait until the end, where I'll show you one of the best 52-week low stocks, a company Warren Buffett bought millions of shares of last quarter, and how $10,000 in it could grow into $1.4 million, paying over $15,000 a month in dividends. So back to the list. Third is Marsh McLennan, ticker symbol MMC. You might not hear that name every day, but in the world of risk management, consulting, and insurance brokering, they are a heavyweight. This is the company that businesses call when things get messy, whether it's a cyber attack, regulatory problems, or financial risk they need to navigate. Even though MMC is fundamentally strong, the stock has been drifting lower. Over the past year, MMC has been down about 2.6%, now trading near its 52-week low of $207.21. So what happened? Analysts trimmed earnings forecasts. Big firms like Barclays and KBW cut their price targets. And even though MMC actually beat profit expectations, their revenue came in a little light. That was enough for Wall Street to cool on the stock, and the momentum fell below some key technical levels. The stock's momentum just couldn't catch a break. But here's what's really going on with the business. MMC is still a cash flow machine. Their return on equity sits around 32%, and operating margins are over 30%. That means they're squeezing an impressive amount of value out of every dollar they use, which is very rare in today's market. On top of that, they've built a reputation for steady dividend hikes and regular share buybacks, exactly what you want to see if you're playing the long game. And despite the short-term negativity, analysts still expect the stock to trade between $230 and $260, which is about 10 to 15% above current levels. In other words, sentiment may be shaky right now, but the fundamentals suggest MMC could bounce back quickly. Marsh McLennan's dividend yield sits at 1.72%. Its dividend growth rate has averaged 11.27%, and the stock has delivered an average annual share price return of 13.63%. Here's what it looks like in practice. If John invests $10,000 into MMC today and reinvests every dividend, after 1 year, his portfolio would grow to $11,535. Give it 10 years and it reaches $41,087. Stick with it for 20 years and it'll be worth $164,057. And after 30 years, that one-time $10,000 grows into $640,434, with $4,813 in yearly dividend income. Of that, $586,888 would come from capital appreciation and $43,545 from reinvested dividends. So the total value added would be $630,434. Second on the list is Exponent, ticker symbol EXPO. Exponent is one of those niche companies you rarely hear about until something breaks. They're the forensic engineers, scientists, and technical consultants called in when businesses need to understand why a product failed, a structure collapsed, or a system glitched. Think of them as the experts behind the scenes solving billion-dollar problems. But lately, the stock has been going through the ringer. Over the past year, EXPO has dropped nearly 31%, sliding down to about $72, its 52-week low. On paper, that sounds rough. Even though they beat last quarter's expectations, year-over-year revenue has gone flat, and that's made people nervous. Growth has slowed, and with no flashy catalysts in the short term, the market started pricing in pessimism. Here's what makes that drop so interesting, though. Exponent's financials are almost spotless. They have very low to no long-term debt, more cash than debt on the books, and a net margin close to 19%. Their return on equity is above 25%, and their return on invested capital is around 28%. These are very solid numbers. When a company is generating returns that are more than double its cost of capital, it means they're creating serious shareholder value with every dollar they spend. Even though it trades at a high PE ratio, many analysts argue that EXPO's premium valuation is justified. The company has a strong moat, stable contracts, and incredibly high client retention. In fact, the market is completely missing the fundamentals here, treating it like a high-growth tech stock instead of what it really is, a slow-burning compounder with pristine financial discipline. And the metrics tell the same story. Exponent's dividend yield stands at 1.65%. Its dividend growth rate is a solid 15.48%, and its annualized share price appreciation is around 12.55%. So if John invests $10,000 into EXPO today and reinvests every dividend, here's the projection chart. After 1 year, it'll grow to $11,420. In 10 years, it'll be valued at $38,513. After 20 years, it'll reach $156,708. And by year 30, that one-time investment could balloon to $685,906, along with around $22,473 in annual dividend income, about $1,873 per month. The total value added to your portfolio will be $675,906. Of that, $537,076 comes from capital appreciation and $138,830 from reinvested dividends. Finally, at the top of our list, and the hardest hit by far, is UnitedHealth Group, with the ticker symbol UNH. If you've been watching the healthcare space, you know this isn't just any company. UNH is a cornerstone of the entire U.S. healthcare system, operating through its insurance wing and Optum Health Services division. But here's the thing, even giants stumble, and when a company this large takes a fall, it makes headlines. Year to date, UNH stock has been crushed, down almost 50%. So what triggered it? Well, it's been a perfect storm. They missed earnings, got tangled up in regulatory investigations tied to Medicare Advantage billing, dealt with some data privacy issues, and then, to top it off, the CEO stepped down. Put all that together, and Wall Street went into full panic mode. Now, here's what's wild. Even with all that noise, UnitedHealth is still profitable, still generating serious cash, and still a dominant force in healthcare. Which raises the question, is this drop really about the business, or is it about fear? Many argue it's the latter. In fact, the average analyst price target is around $380, which is 30 to 40% higher than where the stock trades today. Add to that the fact that UNH is now well below its long-term moving averages, a rare sight for this company. For long-term investors, that kind of setup often screams opportunity. UnitedHealth has a history of aggressively growing its dividend, with a dividend growth rate of over 16%. Pair that with expanding services and margins, and you start to see why this sell-off might actually be planting the seeds for its next big run. Panic, after all, creates mispricing, and mispricing creates opportunity. Now let's look what this could mean in real numbers. UnitedHealth's dividend yield today is about 2.91%. Its dividend growth rate is 16.01%, and historically, the stock has delivered an average annual return of around 9.25%. So based on these metrics, let's say John invests $10,000 in UNH right now and reinvests all the dividends. After 1 year, he'd have about $11,216. In 10 years, that grows to $34,623. Fast forward 20 years, and it's worth $164,834. And if John sticks with it for 30 years, that single $10,000 turns into a staggering $1,408,142. Around that time, this portfolio will be paying $212,280 in annual dividend income, or about $17,690 in monthly dividend income. The total value added over 30 years would be a staggering $1,398,142. Out of that, $862,721 comes from reinvested dividends and $535,421 from capital appreciation. Don't have the $10,000 to start? No worries. Click the video on the screen to see how you can build up to $7,000 a month in dividends, starting with just $20 a week.